Welcome to Prescribing Prosperity with your hosts, John and Alex Soutos from MedWealth Financial Services, operating through IPC Securities Corporation. In this podcast, we provide unique insights into wealth management, the psychology of financial decisions, and help listeners place the capital markets into perspective. Our aim is to help physicians, business owners, and other medical professionals to live their dream. Life is to live and enjoy, so we'll also cover health and lifestyle-related topics such as food, dining, travel, and unique experiences. Learn how global trends shape our investment strategy as we help you assemble your roadmap to prosperity.
Hello, and welcome to the Prescribing Prosperity podcast with your hosts, John and Alex Soutos. John, you went and got a cup of tea in between episodes.
I decided to make a coffee.
Oh, okay. Coffee instead of tea. I don't know if that's a proper Canadian thing to do, Alex, or not.
My wife's Italian. I've been indoctrinated.
Okay, good. As long as it's like a nice stiff cup of coffee, then we're in good shape. Well, last time we tackled the fun topic of kids and the stuff that nobody tells you that you need to know. Really, you do need to know. This episode, Alex, is going to be interesting because, we left on the note of change. The last episode, for those who didn't listen to it, go back and give it a listen. We ended it on change and the note that things change, whether we want to or not. We go through changes and things happen. So with that setup, Alex, I'm going to let you dive into topic number one for today.
Yes. So one of the biggest changes anybody could experience in their life is the breakdown of their marriage. And that's something that nobody plans for, nobody wants to happen. But no matter what, the odds say that 50% of marriages end in divorce. So actually, I think it's higher now. I think it's more than 50%. But anyway, I digress. We need to prepare, or you need to be prepared, if not mentally, then financially, for the considerations that would go along with that type of event unfolding. And so one of the major things that people need to prepare themselves for is the cost of legal advice and the cost of legal proceedings. There's going to be things like spousal support, equalization payments to the spouse who's earning less money. You can have a prenuptial agreement in place, but people need to understand that a prenuptial agreement only really protects the assets that you had prior to entering into the marriage. Anything that you've accumulated during the marriage itself is fair game.
Yeah.
So with that, Dad, do you want to talk a little bit about, you've gone through this obviously with a lot of clients. What would those costs look like?
Well, the legal costs obviously are the most significant ones, and anyone who's a lawyer knows that your first tactic is to defer, and as delays and defers occur, costs accumulate. So you don't want to get to that point. Well, ideally, what you want to do, and I'm not a marriage counselor, so everyone has to understand that, but from my common sense perspective, is whatever the issue was that caused the marital breakdown, get past it, and then talk common sense and say, okay, let's just do this matter-of-factly. This is what we have. We're going to split it down the middle, sign a paper in front of a lawyer, and formalize it, and let's get it over and done with. If not, then you're talking about 10, 20, 30, 40. There's no limit. The thousands of dollars will accumulate.
So, John, it has in fact been said that the single largest destruction or destroyer of wealth is divorce.
Yes.
And I think we need
ask Johnny Carson.
Yeah, he went through it like, God, I lost track of how many wives he had.
Well, the first one was the big one.
Divorce is more expensive than you can imagine. Forget the emotional and psychological impacts that it has on you, but the fiscal impacts are massive.
Yeah.
Is that why Larry King worked so long? He had like 9 marriages.
Yes.
Larry King couldn't afford to not work.
Yes.
Sadly. Did you hear that, Bill? 9 marriages to 8 women. That meant he went back for seconds.
I went back for seconds with one of them. I know.
Why?
Yeah, well, I'm sure he figured out the separation agreements after the first two,
They had it. They had a form letter prepared already for him. Just handed it
essentially.
to whatever wife had
Probably, they
performed.
Yeah.
probably did, as a matter of
So,
fact.
so I don't think you can financially prepare a bill for divorce. I
Yeah.
think what you need to do is prepare. When I say you can't financially prepare, what I mean by that is you can't say, okay, I'm going to set aside $50,000 for my upcoming divorce. You can't do that.
Right.
What you do need to do though is if you find yourself in that situation, then you know what? Sometimes it's not just about divorce. It could be a second marriage due to the death of a spouse.
Yeah.
And this is also a big issue. And this happens especially later in life for people in our generation. And so you have to start thinking of, okay, so I'm bringing a new spouse into the equation. What's the relationship going to be like? What's the financial relationship going to be like? Am I going to, if in my will, do I include the new spouse in my will? If so, to what extent? And so this is a subjective area, and it's very difficult to answer. The adult kids are not going to be happy about that. Potentially, that they're going to be sharing some of the proceeds of the will with someone they're not related to, and it really complicates factors.
Yeah, but
So
let me back you up for one quick second,
yeah,
though.
yeah,
Let's say that, for whatever reason, a client of yours, they've reached a place where they're like, we need a divorce. We're going to have
right,
a divorce. Okay.
yeah.
And it's unfortunate. But what is your financial counsel, if you will, in terms of, because they come in as a couple and they have a lot of assuming they have a lot of assets that are jointly held. They have a lot of, they may have kids. They may have a house. I mean, how do you guide people through all of that so that they get from point A to point B with the least amount of complications?
Well, this is as we've agreed, this is a very complex matter, and I'm not a divorce counselor.
No, I understand that.
And so all we can do is handle with the financial aspects. So here in Canada, if you have a registered retirement savings plan, the equivalent of an IRA in the US, and there is a settlement,
Yeah.
money can be extracted from your retirement account and transferred to the
Is it a
divorced spouses.
50-50 deal?
Not necessarily. There has to be an agreement between the two divorcing spouses as to what the allocation is going to be. Obviously, there could be an arbitrator or a third-party intermediary who says, "Okay, it's going to be X. You're going to get the house. You're going to keep the retirement assets." Right?
Gotcha.
They can do it. They can do it that way. So I had a marital breakdown in one of my clients recently, and that's exactly what happened. The one spouse said, "Okay, I want to keep this as simple as possible. I want to keep the legal expenses down. You take the house. I'm keeping all of my retirement assets, and that's it." Or sometimes it's 50-50. And then you move on. But the thing is, it's as Alexander said, unfortunately in today's world, there's a good probability there is going to be a marital breakdown. And if not for that reason, then for reasons of potentially a spouse dying prematurely,
Right.
whether it's early in life or later in life. And this is this goes back to our discussion about insurance as well. So you buy life insurance, the one spouse dies, the insurance pays out to the remaining spouse. Now they get remarried potentially.
Hold on, before we get into the second marriage, Dad, hold on.
Yeah.
What about something like amending the wills? So you have, legal documentation that you've drafted on behalf of, a couple. What happens to those wills if if the marriage were to break down?
Oh, they would have to be redrafted if the marriage were to break down. And again, it's a subjective matter. Do you, in the event of your passing, still want to have some financial consideration for your original spouse, even though you may no longer be married to them? You may still have a decent relationship. In which case you might say, you know what, I still want to recognize that relationship that we had for an extended time frame, and I want to set aside some money for them. So yes, the wills will have to be rewritten and modified to reflect the new reality. And you want to keep it to no more than 2 spouses, because then it becomes really complicated if you get into 3 and 4 in terms of allocating assets, and then the assets get dwindled very rapidly. It's actually a source of wealth destruction. So, this reminds me of the entrepreneurial families here in Canada. We had an entrepreneurial family called the Eaton family that established a big department store, and it took 4 generations to destroy that wealth. And my understanding is businesses like that typically only last 2 generations, and
I was
sometimes
gonna say,
3.
it's usually within 3.
Yeah,
3
usually
is the rule of thumb.
that's right.
What,
So
short tails to short tails in 3 generations, something like that.
yeah. So if you apply that to the marriage comparison metaphor, you say 3 spouses. So once you get to 3 spouses, you have complete wealth destruction, unless you're planning really, really carefully with prenuptials. So yeah, so obviously all your legal documentation has to be redone in terms of wills, your ownership of assets, reallocating retirement savings, potentially reallocating pensions. Some people don't have voluntary retirement accounts. They belong to pension plans. Like here in Canada, the teachers, very few teachers have any RRSPs of any significance. All their money's tied up in their pension plan. So potentially you could see your 50% of your pension go to your spouse. So these are all the nuances and complexities of marital breakdown. And so the key is try and choose wisely from the beginning, and try and be adaptable to life to your spouse, because as Charles Darwin said, and everyone thinks Charles Darwin said survival of the fittest, but really the key to survival is adaptability. And when you marry another person, you have to realize that you can't do everything your own way anymore. There has to be modification and adaptation. And if you're not of that nature, you may want to question the merits of a marriage to begin with. But if you are going to get married and you're not of that nature, you got to be prepared to start adapting and changing, so you don't run into this potential inevitability.
Yeah, or find somebody else who's very adaptable.
Yeah, that's
okay.
That's the other option.
Well, that leads me to the question about, what if you just didn't get enough? You got a divorce and then you went into a second marriage. Well, I mean,
Yeah,
I'm assuming maybe you learned your lesson and you're either more adaptable, or you found somebody who is extraordinarily adaptable. But
yeah.
Well, Bill, I had a client who was divorced, and it was the spouse from hell, who, despite getting a settlement on a monthly basis for childcare and spousal support, and who entered into a secondary relationship. This person is clinging on to that original spouse out of spite and trying to vindicate what happened, and still is financially hiring lawyers to get more.
But hold on, once you get remarried, doesn't the spousal support go away?
That depends on what the original agreement is, and
Right,
that depends on entrepreneurial legal teams.
And I will say, just as anecdotally, I actually know a guy whose spouse did exactly that.
Yeah.
And he kept saying, there's going to be no money left if you keep this up. There's going to be no money left.
Yeah.
And she replied, I don't care.
Yeah, as actually it might be the objective.
Which is like,
it might be the objective.
which is the saddest thing of all. It's like, if you're going to get a divorce, move on. Everybody,
exactly.
move on. That's really, really, really simple. But for those people who move on and go to a second marriage, John, they've got to be financial, legal complications that just sort of escape me. I mean,
Well, I think most of those financial legal obligations has to do with agreements as to if the kids are still kids, if they're below age of majority, you have to have agreements as to who's going to fund their upbringing, who's going to fund post-secondary, who's going to fund the post-secondary education. I mean, these are complexities that we don't have time to get into all the details, but suffice it to say, all legal documents, all financial documents are going to have to be restructured to reflect the new reality. Now, there are marital breakdowns, and I do have clients in this situation where it's not acrimonious, where
Right.
they're not after each other's hide, in which case they agree to retain the assets as they are, and then eventually just split the income at retirement. And so it's all a function of how you approach it. You can approach it in an angry, divisive, vindictive manner, or you can say, this is my new reality. I have to deal with it. The other party has to deal with it. So let's move forward amicably. And that would be the best solution, is if you can have that kind of arrangement. And so I've seen both extremes. But the one extreme that the one situation that I find is actually worse than divorces is the marriage of a second spouse after the death of a first spouse. That creates enormous interpersonal challenges between the new spouse and the children, or the adult children. That is actually far more difficult to cope with than I shouldn't say in every instance, obviously, there's exceptions, but I find more commonly that situation creates a lot more financial upheaval, because it usually happens later in life, and you get the whole question about the will. And should the spouse get a portion of the will? Should what percentage is that going to be? The adult children saying, "Why are you giving some of my money to your new friend? What did they do to earn that?" Right? And it is messy. It is messy. It is sad. It's heartbreaking in many instances. Family relationships sometimes break down permanently. So, and as much as divorces are very disruptive, having a second spouse after the death of a first spouse can actually create a lot more problems. So you want to be clear-headed when you're planning for these things. And if you're going to get into a second relationship, if a first spouse dies, you want to upfront in that new relationship say, look, I've accumulated a certain amount of assets during my lifetime. These are going to my family. You're not getting any piece of this. Or you can say, I hate my children, and you're going to get half of this. Make sure you keep me alive as long as possible. You're only going to get it if I hit 100. If I don't hit 100 and you're not taking care of me, kids get it, right? So anyway, it's I'm joking, obviously, but different ways to approach this. But it's something that you want to give some thought to. And you know what? When you're in this situation, you also want to get guidance from thoughtful friends, professionals. Don't try and do this stuff on your own, because it's difficult when you lack perspective.
And what would you recommend in terms of combining assets in a second marriage? Knowing that, you went through a first marriage that didn't work out. And obviously, when it comes to marriage breakdown, we've already discussed that whatever you accumulate during the marriage is split anyway. But for the simplicity of paperwork and administration, is it easier for the spouses in a second marriage just to keep all their own individual assets separate and not have any joint accounts or joint?
I think from a complexity perspective, it makes sense to keep it separate. However, there are other complicating factors, and that has to do with taxes. So, as you know, here in Canada, if one spouse passes away, they can roll their retirement savings to the surviving spouse's RSP on a tax-free basis. Whereas if you don't designate that second spouse as your spouse, and it goes to the estate, then it has to be processed through the estate. The appropriate taxes are paid in the settlement of that estate, and proceeds then go to the first family's issue.
Right.
And so the second spouse gets left out in the cold in that situation, potentially. So
life insurance can also be amended to add the second spouse?
It depends on what jurisdiction you're in. So the very strict rules in Quebec, more flexible rules here in the rest of Canada, but you can have what they call revocable and non-revocable beneficiary designations. So I believe in Quebec, and don't quote me on this, in Quebec, essentially it's non-revocable. So your spouses are going to get money from you, whether you like it or not, from an insurance policy or from certain assets. But I'm not 100% on that, so I don't want to be held accountable for my comments about Quebec. But you can have either revocable or non-revocable beneficiary designations in insurance policies. And for the sake of flexibility, my general guidance to people is to always have revocable beneficiary designations. That gives you the flexibility to make changes when necessary.
Right. Okay. All right. So I think that ties that one up pretty well. So the next major life event that people often encounter is managing the declining health.
Oh, yeah.
Now that
Okay.
can be. Sorry, go ahead.
This is Bill and I's bailiwick now, because
This is feeling very personal now.
yeah.
Okay. Well, hold on. Let's just let me finish introducing the topic before the two of you get on and rant and rave. But we want to discuss, how managing the declining health of a parent, a spouse, or your own health can create some challenges. And so, one of the things that we often discuss with people is, how is your lifestyle going to change? Who's going to help look after you, or who's going to help look after the parent or spouse or whomever happens to be the one who is facing diminished health.
Okay, so this is like the last topic, can be very complicated, and it also depends on the capabilities of the one who is aging.
Mm-hmm.
So in our case, let me back up a step. When you have uncertainties, you must hedge against those uncertainties. And for people who are not independently wealthy, the best way to hedge against uncertainty is insurance. So in planning for the declining health, one of the things you can do is buy critical illness insurance or long-term care insurance. So long-term care insurance provides for a cash flow to the person should they be deemed incapable of looking after themselves, and that can be a monthly payment that helps them to have in-home care or institutional care. And there's some flexibility as to what that costs and what coverage you want. Right. So in my case personally, I'm the child of immigrants who came here with few skills. And our parents became, well, the one parent became dependent on us for assistance. And so fortunately, because I'm in the financial industry, when my mom reached a certain age, I bought long-term care insurance, split the cost with my brother. And over the course of 10 years, that was paid up. And then at some point, that insurance was triggered. And it allowed for my mom to experience some alleviation of circumstances that otherwise would have been very negative, and that is institutionalized care. She was able to remain in her home with in-home care and support, and she passed away at home. Institutional care, it's better than nothing, I suppose. But you hear horror stories about people who end up in institutional care. You're dealing with support staff that become insensitive to the pains and emotions of the people they're caring for, just by virtue of having to maintain their own sanity. They can't get emotionally attached, and so it's not a pleasant environment for people to age in. So ideally, you want to look at long-term care insurance, and that's a financial planning tool to utilize if you're a 50-plus-year-old person and you want to make sure your parents are going to be looked after. That's something you can do. You can either pay for it yourself with your siblings, or you can get your parents to pay for it. All dependent, of course, on financial ability of everyone involved. The other thing is we are learning more and more about health these days, and one thing we're learning about things like dementia and all its complexities, and there are various forms of dementia and Alzheimer's. And I'm not a medical expert and I can't tell you all the nuances, but we know they're different. What we've learned is that the causes of dementia are not always genetic. In fact, most of the time they're dietary and lifestyle in their source, and the causes take 20 years to manifest and show up. So by the time the first symptoms of dementia appear, it's almost too late. I suppose there's probably a few things you can do from a dietary and lifestyle perspective to ameliorate the impact,
Yeah.
but really it begins 20 years before. So one thing I've learned from my own health challenges is the negative impact that sugar, artificial sweeteners, and simple carbohydrates have on the impact they have on our health, both short and long term. And following a good, balanced diet, a Mediterranean diet, and maintaining exercise. Once again, I'm going to advocate for the podcast of Dr. Peter Attia, who is a longevity practicing longevity expert and medical professional in the United States. I think he's based in Austin, Texas. Encourage people to listen to that podcast to learn about aging well and know everything you can do to help yourself. So these are all good things. But I do have people that I've been dealing with for 4 decades, and they say to me, John, I have enough money. And my response to them is, you don't know if you have enough money, because right now you're 70 years old, you're feeling financially stable, you're feeling financially healthy, but what you don't know is in 10, 15, 20 years, you might need to be in a long-term care facility. You might need in-home care. You don't know how your health is going to change in the future, in which case you're going to need additional money. So don't assume that you arrive at retirement with X amount of dollars, that you're financially set for life and you can stick your money in an interest-bearing investment getting 4% a year or 3% a year. You constantly need growth of your capital, because costs are constantly going up. You have inflation, even at a 2% rate. The cost of living is going to double over a 30-year period. And so you really need to focus in on ensuring that your money is constantly invested in a fashion that's going to encourage capital growth and capital accumulation. So this whole thing about, you get to 65, you take 65, subtract it from 100, and you have 35 is the difference. So that's what goes into stocks, and 65% goes into bonds. That was a general financial planning rule of thumb when I was a young advisor, and that advice is wrong. The advice should be goals-based financial planning, and that is, what are my goals? My goals are to ensure I have financial resources at my disposal for the rest of my life, whether that be because I wish to travel or because I want to have health care. You need to be goals-based in your savings and investment strategies.
Yeah, and just to put some numbers to that, we talked about the nursing care. So for a part-time 4 hours per day nursing at home,
or
costs
PSW
costs around $60,000, almost $61,000 per year. That's for 4 hours a day. So that means the other 20 hours, obviously you're sleeping during some of it, but the other 20 hours, you got to be functional on your own to not need someone to come in. If you need somebody on a permanent basis, whether that be in a long-term care facility or somebody who comes to your house and is there during the day, you're looking at upwards of $72,000 to $120,000 per year. That is an enormous cost that people do not anticipate.
I actually had a client who was in such a diminished state that the personal support worker actually became a live-in person, and that cost is enormous.
Astronomical. Well, you have to look at it. You got to think, okay, if I become physically diminished in my capacity, am I going to be able to perform household chores? Can I clean? Can I cook? If not, that costs money. Somebody's got to provide those services for
Never
you.
mind that. Can you go to the bathroom?
Well, exactly.
Can you bathe yourself? Can you dress yourself? These are the difficult things.
And so, those all cost money.
Yeah.
And so far too many times people don't think that that's going to happen to them, and so they don't plan for it. So then you're at retirement, you're left sitting there going, crap, I don't have enough. And then you gotta figure it out. And a lot of times you're forced into a decision that you probably don't want to make.
The factor that people talk about longevity and lifespan, what we don't talk often enough about is health span, and that is how long into your total existence do you remain healthy enough to care for yourself and enjoy your life. And that begins earlier in life. It begins with the need for a daily exercise and eating appropriate things. And there's a lot of great books and a lot of great speakers out there who will speak to this subject matter. And I would encourage people to go out there and find these individuals. Stay tuned to our podcast, because we will have some of these individuals on our podcast. We will reference them. And for those people who are interested, you can reach out to us and we can give you some ideas. But it all begins with a healthy diet. And for the majority of the population, not 100%, but for the majority of the population, that means a Mediterranean diet, which is plant-based with a decent amount of protein and the avoidance of sugar. And these are things that I think a lot of people have already caught on to, but there's a lot of people who haven't.
Right. So one last question that we're going to quickly get in here before we wrap up is, when should you be purchasing health insurance and when is it too late?
So on the subject of critical illness and long-term care insurance, and even for life insurance, the time you want to get it is when you don't need it. So for life insurance, that's when you're a young person. So that's when you're 25 to 35 years old. You want to get, even if you don't have children. Because insurance is something that is very different from every other product or service out there. You can't just buy it when you want it. You have to qualify for it. And so when you're young, the probability of qualifying for life insurance is very high. But as you age, as stuff starts to accumulate, as bad habits begin to accumulate, you may not be able to qualify, or you qualify at a higher cost. That's for life insurance. In terms of long-term care insurance, that's something you can start at any time, but typically most people don't have the cash flow. But I'd say once you hit about 45, 50 years old and your cash flow improves, you may want to look at long-term care insurance to protect yourself from potential future disabilities that you may encounter, and also critical illness insurance in the event you get there's a catastrophic diagnosis of cancer or heart disease. So that is generally their age. Obviously, whenever you can afford it is great, but the reality is most people can't afford these things till they're in the decade between age 45 and 55.
Okay. Yeah, I think that's good advice. And with that, we're going to turn it back over to Bill, and we'll wrap it up.
Yeah, no, this is great, and I deliberately restrain myself from commenting in the latter part of this podcast, because there are things you can do, as John, you pointed out, to take care of yourself, to manage your own health decline, but there are things that happen, as we know. Things in life happen. So the best that you can do, and the wisest advice is, prepare. And maybe it never happens, and then you're prepared. That's the worst case scenario, right?
Yes.
This is great. So for people who are listening to this podcast who are thinking maybe they need to do some preparation of their own, maybe they should have a conversation with the two of you, what is the best way for them to reach out to you?
Yes, best way is to send us an email at info@medwealth.ca or visit our website.
Beautiful. And as always, that information is also in the show notes. So for those of you who aren't able to take a note right now, come back and look in the show notes. All the contact information is there. I want to thank you for taking the time to listen today, and remind you one of the easiest things that you could do is simply reach out and hit the follow button and become a subscriber. That way, every time John and Alex drop a new episode of the podcast, you will be notified. You can give it a listen. I personally would also ask that if you like the podcast, please tell other people about it. Word of mouth promotion is very welcome. We would love it if you would tell people that you find this podcast interesting and useful. Until next time, I'm Bill Tucker on behalf of John, Alex, and everybody at MedWealth Advisors. Thank you for taking the time to listen today. And we will remind you that you can go out today and make today a great day or not. It's your choice. Use it wisely. Thanks for listening.
Thank you for listening to Prescribing Prosperity. Visit our website at med-wealth.ca That's med-wealth.ca for more information or to connect with us for a consultation. Don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the hosts and their guests and does not necessarily represent the views or opinions of IPC Securities Corporation. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investment advice. Always seek the advice of a qualified and licensed financial service provider with any questions you may have regarding your investment or retirement planning. MedWealth Financial Services can provide a private consultation to help you determine the suitability of any guidance discussed on the show.